savings account versus cash value. Which one builds wealth faster? Let's do a quick side-by-side comparison. So in a permanent insurance or cash value account, you typically get 8 to 15% back on your money accredited to you every single year. In a savings account, you get 0.35 to about 4% on the high range, on the high range on average accredited to your account. Now, if we just look at a simple example, now in this example, I'm going to be as fair as possible to the savings account, and I'm going to be as unfair as possible to the permanent life insurance. And we're going to be comparing $1,000 invested in an account and see what that would look like compounding every single year. Okay, so on average, most people are getting in a regular bank account about 0.35% in their savings account back on their money. Now, there are accounts out there that will give you around 4%, some 3%, some 2%, but they will give you this back on your money. I have one of those accounts that's called Exos. I have one of those accounts personally myself. Okay. Now, on a permanent life insurance with cash value account, you get anywhere from 8% to about 15%. But as I said, I'm going to be as unfair as possible, so I'm not even going to show you the average. We're going to be comparing 6%. Okay, even less. Okay, so 6% will be comparing to their 4%. Okay, now let's just say the average person has $1,000 in their account. Now in this account, they're putting in, let's say, $100 per month to keep growing the account. Okay, now let's just compare what $1,000 base plus $100 every single month would look like for this account versus this account. Okay, and let's say in 12 months, 12 times 100, that's 1200. So 1200 plus 1000 equals 22,000. That's what you have if you just put the money in there. Okay, so that's 1200. Okay, that's right there, equals 2200. Okay, now let's see what their accreditation would look like. Now I know every single month their accreditation is going to look a little bit different comparatively to each account. Okay, so 2200, okay, times 0.04. You gotta move the decimal. Hopefully we pay attention to school. 04 will be $88. Okay, so you have $88 that will be accredited to this money that you have right here. 2200 plus $88 will give you $2,288 in this account. Okay, that's how much that would be. Now, if you keep going year by year, so you keep putting that in there. Let's say every year for the next 5 years, you put in 2200 every single year for the next 5 years. What that would be? That would be $11,000 of your own money, and then interest on top of that, because it's 4% times 0.04 will be $440. So 11,000 in 5 years will be the amount of money that you put in there, plus $440 would be $11,440 is the interest that you have accredited to you in a regular savings account. It's not bad. All you're doing is putting the money in there for an emergency. It's not bad at all, okay? Now, if we just compare this to this one over here, okay, to the permanent insurance at just 6%. Just 6%, okay? So you start out, same thing, 1,000 plus you're putting $100 in there every month. So plus 1,200. You do the same thing, 2,200. So 2,200 on this side. Interest accredited is 6%. So times 0.06 equals 132. So 2,200 plus 132 equals 2,332. Okay? All right. Now for that 2,332, same thing we did. All right? You say you're putting this 2,200 for 5 years into an account. Okay? This 2,200 was going to give you 11,000. From this 11,000, same thing. We just move this money over here. From this 11,000, Okay, you're going to be accredited interest of 6% because we're doing it the same way that we did over here. We're going to do the same thing over here. We're going to try to make it as fair as possible. Okay, so the same interest that you credited over there, so 0.066% is $660. Okay, so $660 plus 11,000 is 11,660. Okay, so just in a side-by-side comparison, if you were to just invest this amount of money, $1,000 base plus $100 invested every single month, okay, for the next year, that'd be 2,200, and then we 2,200 times 5 because you do that for 5 years, okay. What that's going to be is on the savings account for the max, what most people are getting. And most people are not getting that. Most people in their savings account are getting this 0.35. That's average bank savings account, what you get back in your savings account. And if you can find a way to get in one of these online banking high yield savings accounts, it will give you around 4%. I know Robinhood is doing like 4.25%. AXO is what I have is giving me 4%. Okay, so there is ways for you to do that, but on average, most people are getting 0.35. So they're not even seeing this money at this level. That's just on average. But as I said in the beginning, I want to be as fair as possible to savings account and as unfair as possible to the permanent insurance. Okay, so on average, you'd be getting more than this, but we just did it for 6%. So 6% comparably to the high yield savings account, 11,660 compared to 11,440. Now, it wouldn't stop there. The reason why it doesn't stop there is because the way that you use this money, okay, this money can only be used via withdrawal. So if you take this money out at any time, right, all this money and all the interest that you're currently accruing right here goes away because you only can take it out on a withdrawal. This side over here, you can take this money out on a withdrawal, but you can also take it out as a policy loan. And taking it out as a policy loan, you're borrowing against your death benefit. Okay, so in your borrowing against death benefit, if you don't pay it back, I'm not saying not to do that, but if you don't pay it back, just take it out your death benefit. Most healthy people can get anywhere from $100,000 to $1 million easy. So if you don't pay this money back, just take it out your death benefit, but the money is still accruing interest for you. Okay, so it is still accruing interest for you. That means the money that you're taking out, you can still use it for multiple different things and still grow money inside the policy. Okay, as that being the case and as that being the fact, this death benefit can also act as wealth management and also wealth creation as well. Because let's say you have 100K to around 1 million in death benefit. This savings account doesn't come with a death benefit. So this money that you're accruing on the low end, 11,660 in 5 years, can also be added to this death benefit that you have. This death benefit goes back to your beneficiary tax-free. And going back to them tax-free, that means all this money goes back to them without any taxes being taken out of it. You following me? So if we just compare on the low end, being as unfair as we can to permanent insurance, comparably to a regular savings account, as being as fair as possibly we can to them, even giving them more advantages. If we compare it side by side, which one will you choose?